So, what does a stock price really mean?
We see it flashing on our screens every single day, right? The market is up, the market is down. It's this number that seems to hold the fate of fortunes in its hands. But what does it truly represent? Well, it's a signal with ripples that go way beyond Wall Street. It affects the companies we work for, our own personal finances, and the entire economy. So today, we're going to follow those ripples. We'll look at what these prices mean for the companies themselves, for households just like yours, for the health of a whole nation, and then we're going to ask if the story the market tells is always the whole story.
Okay, let's start with the company itself. For a publicly traded business, a high stock price isn't just a report card. It's a genuine superpower. It gives them some pretty powerful tools for both offense and defense.
Think of a rising stock price as this huge vote of confidence from the market. It's the investing world signaling that it believes in the company's vision, its leadership, and most importantly, its future. And that public seal of approval, it's incredibly valuable. And that confidence kicks off this powerful positive feedback loop. See, a higher stock price directly increases the company's equity value. With more equity on its books, the company looks like a much safer bet to banks. And what does that mean? It means it can get loans more easily and, crucially, at cheaper interest rates. That cheaper capital can then be plowed right back into the business for more investment, more research, and more growth. This power really comes to life in the high-stakes game of mergers and acquisitions. On defense, a high stock price is like a force field. It makes the company way too expensive for a hostile takeover. But on offense, it becomes a weapon. A company can actually use its own valuable stock as currency to buy other businesses, something called a stock swap, making it a serious predator in the market. And this influence, it touches pretty much everything. A strong stock makes it easier to raise cash, it's often tied directly to how executives get paid, and it helps attract the best talent through employee stock plans. At its core, it helps the company deliver on its main promise, creating value for its shareholders. So that's the corporate superpower. But how does all of this translate to your wallet? Well, these rising prices don't just stay on a corporate balance sheet. They ripple out directly into the finances of everyday households. This is what economists call the wealth effect. Just imagine your retirement portfolio goes up by, say, 10 grand. Now, even if that gain is just on paper, you haven't sold a single share, you simply feel richer. And that psychological boost is very, very real. And when people feel wealthier, they tend to act wealthier. That feeling of financial security often gives them more confidence to go out and spend money on, everything from a new car to a kitchen remodel, which in turn helps stimulate the broader economy.
There's a really powerful analogy for this from the years leading up to the 2008 financial crisis. As U.S. house prices were soaring, people didn't just feel richer, they acted on it. They refinanced their mortgages, pulling cash out against their home's new higher value. As one source put it so perfectly, the house was basically being used like an ATM, and it funded a massive wave of consumer spending.
Okay, so we've seen the impact on companies and on households. But when you bundle all of those effects together, stock prices can start to look like a barometer for an entire nation's economic health. The way we track this is by looking at a stock index, like the DAX in Germany or the S&P 500 in the US. These indexes just bundle the performance of the biggest, most important companies into a single, easy-to-read number. It's like a quick snapshot of the country's economic pulse. Now, the reason the stock market gets so much attention is because it's a leading indicator. It isn't just reflecting what's happening today. It's a collective bet on the future. So a rising market suggests that on the whole, investors expect profits to grow and the economy to expand in the coming months. It seems like a pretty neat and tidy system, doesn't it? A rising market means a healthy economy. But it's not always quite that simple, is it? Is it possible that this economic barometer can sometimes give us a misleading reading? And the short answer is yeah. The stock market isn't a perfect mirror of the real economy. Sometimes that reflection can get pretty distorted by other powerful forces at play. And here's where the distortion comes in. Not everyone benefits from rising asset prices. I mean, it's great for the people who actually own stocks and real estate. Their wealth grows. But for everyone else, it can mean the exact opposite.
things like higher rents and the dream of home ownership getting pushed even further away. It's really just two sides of the same coin. On one side, you have asset owners watching their net worth climb. But on the other, you have non-owners who are now facing a higher cost of living, which makes it even harder for them to buy the very assets that are creating all that wealth. The same rising price is a blessing for one group and a burden for another. This brings us to a key critique of a policy you've probably heard of called quantitative easing, or QE. To help the economy, central banks pumped enormous amounts of money into the financial system. Now, one of the major side effects was that all this cash pushed up the prices of assets like stocks and real estate. This led critics to argue that the policy, while well-intentioned, ended up widening that wealth gap between those who own assets and those who don't.
Which leaves us with this one last big question. If the stock market is our economic barometer, what happens when its readings are being influenced by something other than the actual economic weather? It's a really important reminder that the number on the screen, well, it always tells a story, but it's not always the complete one.